The biggest mover in FX markets this week was the British pound, which rose more than 2% as the UK announced a snap election for the 8th of June. Sterling's rally was presumably bolstered by the prospect of extended political stability domestically and perhaps strengthening the hand of UK PM May in the Brexit negotiations. However, we do question whether there was much of a risk premium on the pound already. The election wasn't due until 2020, and the opposition to the Tories had been quite weak anyway. The UK is still going to face a very difficult process of negotiation over Brexit, so we still think that the pound is going to struggle in the face of that uncertainty. Moreover, the campaign so far has kicked off with PM May pledging to lower immigration, which is consistent with the so-called hard Brexit option, which financial markets generally don't like. The Aussie dollar fell below the 59 pence level against the pound this week in response to the election news, but we suspect that this strength in the pound is temporary. The Aussie dollar meanwhile fell 1 cent against the US dollar from Monday to Wednesday, with some of that selling coming after the Reserve Bank minutes from the April meeting. In the minutes, there was an increased focus on concern over the job market and also house prices. In terms of what the RBA wants to see done on cooling the housing market and excessive borrowing, its focus remains on supervisory measures aimed at investor loans. As for the job market, though, the obvious response to weakness in job creation is another interest rate cut. Pricing for another RBA rate cut by the August meeting is around 20%. However, since the meeting, we have of course seen the strong March jobs numbers, which weren't covered in the minutes. As such, the RBA's concern over the job market is likely to be a little lessened compared to those minutes. Pricing for another RBA rate cut could also be reduced in the week ahead as we see Australia's first quarter inflation numbers on Wednesday. Westpac expects the CPI to have risen 0.6% in the quarter. That's 2.3% year over year. That would be the first time since September 2014 that Australia's inflation rate has been within the RBA's 2 to 3% band. The combination of the rebound in jobs numbers and such an inflation reading to us reinforces our view that the RBA will not touch the cash rate in 2017 and indeed not probably in 2018 either. Such a CPI reading should help the Aussie dollar recover some of its recent lost ground. So too should signs of stabilisation in iron ore markets. The iron ore price has fallen about $30 over the past month to as low as $63 a tonne this week. However, it has started to show signs that it is stabilising and may push a little bit higher. After all, the hard numbers on China's economy for March, including GDP and industrial production, were actually reasonably encouraging. The US market focus in the week ahead is likely to be on the first quarter GDP reading at the end of the week. This is shaping up as quite a soft number and will continue to raise doubts in markets over whether the Fed will raise rates again in June. Market pricing for such an outcome, which is Westpac's view, continues to bounce around either side of the 50% mark. Europe's focus in the week ahead, of course, will be on the aftermath of the French presidential election first round vote. If markets remain volatile and nervous, then this could impact on global sentiment and see the Aussie test towards the 74.50 area. But overall, we're a little more optimistic and expect that the Aussie will trade mostly in a range of 75 to 76 in the week ahead. We'll speak to you next week.